Yes. So I would say anybody who's listening who has a mortgage with TD, a mortgage with CIBC, a mortgage with BMO, maybe RBC depending, and you're on a variable rate, if you log on to your online banking and check what your amortization is, if you have not made any additional payments over the past year, you're going to see a number that's a lot higher than 30. So I've seen amortizations as high as 53 years.
Whoa.
And the reason for that is because people's, as you mentioned, trigger rate, that means people's monthly payments no longer cover the interest portion of the mortgage. So you're not even making the full interest payment, meaning they're just extending your amortization as long as they can.
What are the pros and cons of that?
The pro of it is during the term of your mortgage, you're not making any additional, you're not having to increase your monthly payment, which I guess is a pro. The con is when your term is up, meaning if you sign a 5-year term, after those 5 years, if you owe 53 years or if there's 53 years on your mortgage, when you renew, you can't renew into a 53-year term or amortization. It has to be brought down to at least 30.
Aren't they going to extend that though?
They might extend to like 35 years, but the issue is that your monthly payment's going to dramatically increase at time of renewal. So if you're not budgeting for it today, we're going to be in a bit of a pickle.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify.
Jeff Mudrick back again on the podcast. Thanks so much for joining us. I just want to jump right in here because the market seems to be going absolutely bananas, and no one seems to be talking about it. What is going on in the mortgage world? What's happening with rates?
They are, as I'm sure you're aware, first off, thanks for having me back. It's been too long. But second of all, yeah, like the market seems to be absolutely up and down on almost like a every other day basis, which is really wild to hear that it's not making the news headlines. Variable rates for the first time in March, they held for the first time in 12 months, which was nice. But what that did is kind of spark, as I'm sure you're aware, sparked a lot of buyer activity. So we're seeing, on the mortgage side, we're seeing tons of like multiple offer situations. A lot of my clients are in those bidding wars again, all throughout the GTA. But then on the mortgage rate side of things, even though variable rates kind of held where they are, we're seeing fixed rates go up and down, as I mentioned, every other day, which is good if you catch it on the low peak, and if we're applying on the high, we're kind of in a challenging spot. So
what are rates right now?
Rates today, what day is it today? April 4th.
Yes.
So we're seeing 5-year fixed rates in the 4% range, like in the high fours. So 4.5, 4.6, 4.7. We're seeing 3-year terms, which are definitely more popular, around the 5% mark. So 5, 5.1, 5.2. And then we're seeing variable rates at like a 6.3. So prime minus 0.4. That's kind of where most lenders are at today.
So rates have come down.
Rates have come down. Probably in October, November, December, rates were at the highest. Like a 5-year fixed, for example, like for comparable, they were at like 5.8%. So those have come down well over 1% in the last 3 months. So anybody who locked into a 5-year fixed in October, November, December, the good news, the bad news is that they're paying a lot more than they need to. The good news is that with a lot of lenders, I don't want to get too technical here, but with a lot of lenders, if you're breaking your mortgage within the first 6 months, then the penalty reverts to a very small 3-month interest penalty, even though you're on a fixed rate, meaning that you can break your mortgage, not pay a ton, and then save a full 1% on your mortgage.
The Bank of Canada is going to come out with another announcement this month. We're shooting this April the 4th. Hopefully I get this out pretty quick. What do you think is going to happen?
My prediction is they're going to hold steady for April.
Really?
That's what I'm thinking, yeah.
Well, how come?
Inflation is on its way down, like according to, the numbers suggest that inflation is on its way down. Even though the Fed increased a few weeks ago, I think in April they're going to hold steady, and then in June, I think they are going to increase it by 0.25%. So if this comes out, that's my prediction. We predicted in March that we're going to hold steady, April we're going to hold steady, and then June probably going to increase by another quarter.
Are we possibly going to see increases at an even more mild, kind of rate? So less than 0.25 point? It seems like we've all just kind of been, either in the half point or quarter point range or 3/4 point, a full percent for the
Yeah.
last year. Are we going to go back to the days of, hey, a 10 basis point increase?
I think I don't know the last time they've increased or decreased by 10. Like I think the standard has kind of always been a 1/4%. However, that being said, last year it was a quarter once, and that was in March of last year, and then every other time it was 0.5%, 0.75%, or a full percent, which we rarely ever see. So, there are some economists suggesting that rates are going to decrease starting at the end of the year. Do I think that's the case? Probably not. However, we're seeing everything that's happening in the States. A couple banks have collapsed, which definitely have an impact on our economy as well.
Talk to me about that. What impact does that have on the Canadian economy?
So when, for example, the Silicon Valley Bank, failed, I guess you can say, in a couple months ago, what happened was the 5-year bond, the bond yield market plummeted. So when that happens, when lenders are forecasting interest rates for the next few years, they take the 5-year bond market into account. So when the bond yield plummets, their borrowing power, their borrowing can increase. They can borrow money for less money. So those savings get passed on to the consumer. So when the banks dropped, pretty much when the bond yield market dropped, pretty much every lender across the board, their fixed interest rates absolutely plummeted. So you could have gotten a 3-year fixed at 4.5 at that time for about like a week, which was amazing. And then a week later, they're back up to 5%. So if you have the right individual working for you, then you could have locked in that 4.5, 4.6% for the next 1, 2, 3, 4, 5 years, and you would have seen a lot of savings.
Wow, so that was actually an opportunity.
Oh, it was amazing. So not only is it the monthly savings that clients have that opportunity with, but because of how qualifying works, for about a week's time, everyone could have qualified for about 6-ish% more than they would have today, which is pretty wild to think about. So because you would take your interest rate, add 2%, and that's what you're qualifying at. So qualifying at 4.5 plus 2%, so at 6.5% versus today you're at 5.1 plus 2, so you're at 7.1% qualifying. It's a huge difference in what people can actually afford.
Now, a lot of people, the age-old saying, if the States sneezes, Canada catches a cold. Should consumers be worried about a tumultuous kind of marketplace in regards to the U.S. banking system when it comes to our economy?
So I can probably defer that to a financial advisor, but what I will say is the Canadian banking system is very, very different, much more regulated. And so I don't really have concerns about our banking system compared to what it's like down south. So again, I would probably defer that more for a financial advisor, someone in the more financial banking space.
Right, because our banks don't do what the U.S. banks did, which was, I think, binging. They were binging on 10-year Treasury bonds. Now we don't necessarily do that. I think we're much more heavily real estate based. Correct me if I'm wrong.
Yeah, I believe so. We are what we've seen over the past little bit is we are much more real estate based. So that's good news and bad news. The good news is think that they're, the stability of our banks are in a pretty good spot. The downside is right now, for example, we're seeing some big banks not really want to lend right now. They don't want to have big mortgages associated with them. They're slowing how much they're investing in real estate. And the reason how we know this is some big banks, their interest rates are through the roof. So I was talking earlier about a 5% interest rate. Certain big banks are at 6%. And the reason for that is they don't want any more of their money tied up in real estate, which is really interesting. So a lot of my business this year has been from lenders who are offering clients terrible renewal rates just because they're okay to lose them. They don't really want that money tied up in real estate anymore.
That's a really interesting, but there is still a competitive marketplace for lending when sales volume plummets so quickly and banks are not they're not processing applications like they normally would. That's also not good for the bank's stock value and all kinds of other things associated with that. And there are pressures to perform, just like in any open marketplace. So I guess where this leads me is for people who are looking, and there are a lot of people looking right now, between the big five, because you're an independent broker, you deal with everybody. Who's the most competitive?
I guess we can say some names.
Yeah.
Like for me, it's the big green one. That
Oh.
is without a doubt, if you want the lowest actual interest rate, and to me, like I love TD's product line. There's so many ways, like so many intricacies in there that you can take advantage of if you know what you're doing and you have someone working with you who knows these guidelines. But from an interest rate, like rate only, it's 100% the big green one, without a
Really?
doubt.
Really? Are there any bonuses that they're offering right
There
now?
are, yeah. Like if you want to get into it, there are like for certain, if your mortgage is over a certain size, they're offering good like cash back incentives right now. Again, I don't work for any bank, but most lenders right now, because of what you said, most lenders are offering some component of cash back because it's a nice like shiny object to throw at consumers. Um, so yeah, like there are definitely deals to be had. It's just around working, knowing which lender to deal with to try to get the best deal.
Talk to me about the 5-year renewals from the people who purchased in 2018 at super low rates. How many of those are you seeing come across your desk, and what are the problems associated with those right now?
Yeah, great question. So as I mentioned, a lot of my business right now is renewals, although that is seeing that shift now because buyers are getting back into purchasing properties, coming out of the house and starting to look. Um, but what I'm seeing is most of our renewals that we're getting, so most clients who purchased in 2018 and need a new mortgage, instead of just doing a straight renewal where, if they bought in 2018 with a 30-year amortization, on paper they should have 25 years left of their mortgage. What we're seeing is a lot of those people refinancing and bringing their amortization back up to 30 years to keep the monthly payments as low as possible. Because when they signed their mortgage in 2018, they were at like a 3% interest rate, let's say. Now they're at 5. So the monthly payment increases, and if people don't want that, then they'll re-amortize their mortgage. They'll re-extend the borrowing, I guess, the life of the mortgage to ensure that their monthly mortgage payments remain low.
Okay, that's super interesting. And throughout this downturn, it seems like the secret weapon, the secret weapon, the magic bullet, the silver bullet of the entire mortgage industry has been amortization. I mean, I bank with TD. I know a bunch of people who bank with TD, and a lot of them were kind of hitting their trigger points, hitting their trigger rates, and uh, thank God I had locked in with a fixed rate at the beginning
Oh,
of 2021.
I know what you're getting it at, and that is quite lovely. So
Well,
yeah.
it's a steal, but that was only because I was like, I mean, at the beginning of 2021, it was like peak greed, and I was like, oh, whoa, this is a little crazy. I'm not gonna get too greedy here. This is nuts. Um, but I remember like looking back at the worst consumer confidence levels, which was I would say probably October, November. That's when people were really like every article was like doomsday
Yeah.
apocalypse is upon us. And during that time, especially with the big five, they were just like, yeah, you hit your trigger rate, no problem. Don't worry, we're just gonna extend your amortization. Everything's fine.
Yes. So I would say anybody who's listening who banks with TD, who banks with CIBC, or sorry, who has a mortgage with TD, a mortgage with CIBC, a mortgage with BMO, maybe RBC, depending, and you're on a variable rate, if you log on to your online banking and check what your amortization is, if you have not made any additional payments over the past year, you're going to see a number that's a lot higher than 30. So I've seen amortizations as high as 53 years,
Whoa.
which will go up and down. Like if variable rates will come down probably in the next 4 years. But yeah, seeing a 53-year amortization is absolutely unheard of, right? And the reason for that is because people's, as you mentioned, trigger rate, that means people's monthly payments no longer cover the interest portion of the mortgage. So you're not even making the full interest payment, meaning they're just extending your amortization as long as they can.
What are the pros and cons of that? Like, can you just extend amortization endlessly?
The pro of it is during the term of your mortgage, you're not making any additional, you're not having to increase your monthly payment, which I guess is a pro. The con is when your term is up, meaning if you sign a 5-year term, after those 5 years, if you owe 53 years or if there's 53 years on your mortgage, when you renew, you can't renew into a 53-year term or amortization. It has to be brought down to at least 30.
Aren't they going to extend that though?
They might extend to like 35 years, but the issue is that your monthly payment's going to dramatically increase at time of renewal. So if you're not budgeting for it today, we're going to be in a bit of a pickle
Okay,
in a
so
few years.
then the pickle is when these mortgages come to term. So we're talking 2025, 2026, 2027, that you're essentially saying if the market doesn't increase dramatically between now and then, which it most likely will, but with the immigration that we have going on right now, which I've been going off about on YouTube, no one seems to care. But if the market doesn't increase and the equity in those properties doesn't increase dramatically at that point, will we see a flood of listings forced onto the market?
We might, however, like again, because we talked about like the banking system in Canada and how much it's regulated. So if the government is seeing that these 50-year amortization, anything over 35, these 35-year amortization, 35 plus year amortizations are X% of mortgages in Canada, my guess is there will be some regulation that comes into place to help these individuals.
Which will just raise the threshold.
That's 100%. It's not solving the problem, but it's making it so that people aren't like losing their homes left, right, and center.
I guess we're on a really good roll here, and I love chatting with you about mortgages and economics because the macroeconomic situation that's happening right now is on everybody's mind. How are you feeling about the central bankers of the world, especially Powell, McClem, talking about this 2% threshold for inflation? Like how reasonable in your mind is it for them to actually make it to 2%?
I don't have a ton of confidence in that number. I know when we started talking here a couple of years ago, you were the person to really hammer down and say, we're not at 2%. We're not at what they're saying. We're at a lot higher than what's being brought to the public. And you're right. So I wonder, like, how long has that been going on for? And is there a possibility that we drop back to 2%? I don't know. I don't see like in the next little bit. And what I mean by next little bit is probably next few years. So if they're not raising their bar, if they're not raising that 2% ideal number, then are they going to keep increasing interest rates? Like, is that going to continue to happen?
Well, can they? And that's the thing is like, can they do it without causing severe damage?
So for a ton of clients in 2020 and 2021, from on a mortgage side of things, what people were doing is using their lines of credit to use as a down payment towards an investment property. Some people think it's so silly, but at the time they were kind of borrowing money for almost free to use as a down payment. So people were borrowing money at, let's say, 2%, and you can borrow $200,000 even less, exactly.
Yeah.
At 2%, which was, looking back, it's free. However, that number right now, they borrowed that $200,000 at 2%. Now they're borrowing that $200,000 at 6.5%. Or more, just over. So it's not affordable for these people. Borrowing X amount of dollars, like it's interest only payments, which is nice, but like you said, is it reasonable to continue to increase payments or increase interest rates this frequently
without destabilizing the
house? Like in my mind, like I have clients reach out and like, how am I going to do this? Like, what's the plan? So we can come up with a strategy, but it's not solving the issue. It's solving the immediate like cash flow issue, but it's not solving the grand scheme of things.
So, and this is where I guess like I'm a big nerd. I'm a huge numbers guy. I'm always like on YouTube going through whatever studies I can find to like, figure out what the hell is exactly going on here because no one seems to really know. And I'm a curious cat. So from what I can tell, and I guess this will kind of result in a question for you. You can't right now raise the overnight rate too aggressively anymore. The Bank of Canada is holding on to bonds that are no longer yielding what they should be, and they're losing money. The entire economy is on the fritz right now and has basically frozen. The liquidity has been yanked out of the marketplace, and people are sweating. What the government's solution for this seems to be is, if we don't have enough liquidity in the market, meaning the dollar is a little bit weakened, how do we prop up the dollar without printing more money? And that seems to be bringing in money from outside the country, foreign wealth coming in, which means immigration, and specifically immigration within economic programs. And that seems to be a massive move. And in fact, it's a huge surge that is record breaking in the country, and not by a little bit, by a lot. So
I think it was double. Was it not double? Like, I know
So-
you just posted a video.
yeah, it's crazy. No one's talking about it. So at the end of last year, they were saying, well, the plan was to do about 500,000 in immigration every single year for the next 3 years. And at the end of last year, they were saying, great, we hit our target, right? And even a little bit more than that. And so everyone was assuming, okay, we took in about 500,000 immigrants. About 60% of all immigration in Canada happens through economic programs. So we're weighting our points system more heavily on the amount of wealth they're bringing into the country, which is exactly what would help to prop up the dollar and prop up our economy. And, great, right? Everybody's happy. Now, we came out with some new numbers from Stats Can and said, well, actually, not only was it 500,000, it was actually 1 million people, which is such a huge difference to increase the Canadian population in 1 year by, I think it was like 2%, 2.4% or something like that in 1 year.
Oh.
We are not prepared for that at all, like not even in the slightest. And we have a huge housing supply shortage as it is. So to have an increase of that magnitude is putting massive strain on housing in Canada. And it's really helping to stabilize our economy on the pro side of things. But the con is, like, our rental market is flooded, which is causing pricing to just skyrocket. We've had a 20% increase year over year. I guess what my question is to you is that what you're seeing on your side? Are you seeing a ton of applications coming in from people who are new to this country?
For me, because of the foreign buyers ban on January 1st, that has slowed. However, and I can't get into the specifics because the announcement just came out, they've already revamped that foreign buyers ban.
Yeah, they've rescinded.
They've rescinded a lot of it.
Yeah.
So, because it was silly.
Well, it's
the
theatrics.
initial 100%. Anyways, we won't get into that right now.
It was political theatrics.
Correct. But they've just walked a lot of it back. So over the past week, yes, I'm seeing more. We're seeing more people from outside the country who can legitimately buy here, even with that foreign buyers ban. Seeing more of that, seeing more conversations happening. I'm on the phone with lawyers, like real estate lawyers, almost at least once a week, asking about a certain situation. Will this fit? Will this not fit based on these guidelines? My specific demographic I work with typically aren't the foreign buyers, even prior to the ban. So, but colleagues of mine for sure, some colleagues specialize in foreign buyers or people coming into Canada to purchase properties. And yeah, we've talked about this on a weekly basis. Like, they are seeing a big intake in applications because, the number that you said, the number that your video, it was amazing. It was the second time I heard it, and it just verified that it is accurate. Initial plan 500,000, actual number 1 million. It's unbelievable. And where are all these people going to live?
So that's the question: is they're flooding the rental market now, but that's because they're new to the country. They don't have credit. So they're going to take, how long is it? So I guess a couple questions for you. How long does
Yeah.
it take for a newcomer to build up credit? And then if they're bringing in money from overseas, how long does that process take? So what kind of lag time are we looking at right now?
I would say if they're coming in with if people are coming into Canada with a plan that they want to buy real estate, you can do it within 6 months. If they come, apply for a credit card, especially if they're bringing wealth with them, it's a lot easier. But it's a pretty simple process. There are tons of new to Canada programs that clients can use to take advantage of. So max like 6 months. You could probably do it within 3 months, but yeah, I would say like 6 month lag time from when people arrive to Canada till when they can purchase. If they're using kind of the right, like if they're really optimizing their, the way of doing things properly.
So we have a roughly, if they're super motivated, let's say a 6 to 12 month
Correct.
lag time of these people who are coming to the country, and they are coming with money ready to purchase, just waiting to build up credit, build that relationship with the bank,
100%.
get an application going, and start moving from the rental market into the buyer's market. So we have a flood, basically a tsunami of buyers that are going to be entering the marketplace.
For sure. So when I say 6 months, that's like people that come in and have, boom, let's do this. Like we know what we want. But most people, what I'm seeing is people will come, they're renting for a year, they'll call and be like, Jeff, my rent's coming up, my 1 year term's coming up for renewal in May, I want to buy. And then they'll have credit, they'll have everything built up, but that's exactly the same situation that you're talking about. Most people, it can take 6 months, but they're going to rent for a year. Most landlords would probably want a 1 year lease agreement. And so after that year's up, they're not renting again, they're buying. They're going to jump in that buyer's pool.
So somebody comes to you right now and says, hey, Jeff, I'm looking to buy. The age-old question, what are you advising people right now in terms of fixed, variable, term, length?
This has honestly changed a lot over the past even like 2 months just because of the interest rate fluctuation. So this is what I say. If their closing is, if they have we can qualify them however we want. But if their closing's in 3 months from now, I would advise probably something different than if their closing's in a month. Just because fixed interest rates are fluctuating like every other day pretty much. If they have a longer closing, we can apply with a variable rate and then lock in whenever that fixed rate has completely plummeted, which is nice, right? We have that flexibility there. If clients are closing in the next few weeks or next month or even 6 weeks, I'm suggesting a very short fixed rate term. Whether it's a 1 year, 2 year, max 3 year, to kind of take advantage of, rates are super high right now. Let's push the rate conversation out 12 months, 24 months and see where it's at that time. I think that most mortgage brokers are taking the same approach. If you have a mortgage broker that is trying to push like a 5-year fixed term today, if it's probably not in your best interest to take that. It's in the mortgage broker's best interest to offer that.
Why?
Just like at a bank would do the same thing. You get paid you get paid more the longer the term is.
Okay.
So if it's a referred mortgage broker and you trust them, like it's fine. But yeah, like my suggestion is the shorter the term possible, or for certain clients, I'm working with clients right now who are wanting a variable rate. They want either a 1 year fixed or a variable rate, and the payments on that are essentially the same today. So that's kind of what I'm recommending today.
What are you seeing happening over the next 60 to 90 days?
With rates?
Yeah.
Yeah, I think this up and down spell is going to continue. So we have clients closing in June and July. It's great because we know there's ceilings that they're going to pay. We have a rate locked in, the absolute ceiling. But with most lenders allow what's called a float down, which is if interest rates drop between now and closing, you'll get the lower of the two rates, your current rate or the rate when it drops. So we have some flexibility there. So I think it's going to continue to go up and down. It's been the case for the last 3 months. And I think that'll continue on for the next little bit.
One more question I wanted to ask you. is surrounding appraisals. I
Mm.
know that that has been a hot topic in the mortgage industry for a while. It's not something that I deal with as much on the actual transactional side of real estate, but I know that they have been up and down for you guys, and that like it will mean the difference between somebody getting their mortgage, scraping by the skin of their teeth to
Yeah.
get their mortgage. Even after they've purchased, the bank says one thing one day, then they buy something based on that information, then they backtrack and change their tune, even though they're pre-approved already. Talk to me about that. Like, what's going on?
Yeah, so I had a conversation with somebody about this as well, and clients understand how important appraisals are. So
They're scared.
they're very scared.
They should they be?
100%. But when I talk to appraisals all the time, I have my list of favorite appraisers, and I will call them and ask them the same question you asked me. What's going on here? What I have found recently is because of the lack of sales volume over the past few months, what appraisers are doing that they haven't done in the past little while is not using just completely sold and closed homes as comparables. They're using conditionally sold or even sold without actually closing.
But hold on. Let me stop you right there. How can an appraiser use a sale that is conditional?
Sorry, not conditional. More so just has sold firm or now is in the firm state, however, hasn't closed yet. Yeah.
But haven't we been doing that forever?
Like last year, for example, most appraisers, what they were doing, they had to use they would use the closed and sold and closed. So for example, they wouldn't look at if a property sold today, even if it's like on the MLS, it shows it's sold. They're not using that as a comparable. They're using the property that's closed yesterday as the comparable.
Okay, this is why, like, sorry, because you're like scrambling my brain here because now I'm thinking, how does that make sense? And this is why I'm always so skeptical about appraisers. Does that make sense when it comes to when the market's on fire and you're in Q1 of 2022, the prices are going up 5% per month and compounding,
Yeah.
and you have an appraiser who's going to look at a value from a closed sale in November and still approve the sale that happened in January. How does that make sense?
These past few years the appraisal companies have had a very challenging, it's been very challenging. Like, how can you appraise a house? Is it reasonable that houses appraise at 5% a month? Like, not really. So what happens in that situation? So appraisers have been pretty good. Like right now, for example, they are using, hey, like this property's even listed at this amount. That's not going on paper, but the conversations I'm having with appraisers are,
they take that into account?
It's something that they look at. Like if we need a certain number, for example, if we need 1.15, if houses are listed and they're kind of running their comparables on that house and it seems to be in the right area, they will take that into their consideration when they're valuing the property.
That's crazy.
Oh, it is. Yeah.
That makes no sense.
Again, it's a whole, like, I love working with appraisers because I love what happens in their mindset and how they're looking at properties.
Well, they're the gatekeepers to the mortgage.
They are. So if you have a good relationship with an appraiser, it can mean that, it shouldn't, but it can mean the difference between getting a property appraised at what you want and maybe 10, 15, 30, 50, $100,000 short. But the reason for that is what I'm doing, if I'm thinking and we're going to be really tight on a property appraising, what I'll do is I will send a whole package using a realtor as well to send me some comparables, what they think is a good comparable, a strong comparable. Using recent listings, I will send that all to the appraisal and make their life hopefully a lot easier.
Right. So you're creating a narrative, you're painting 100%. A picture, you're
telling a story.
Yeah, and you're gonna pick the ones out of the pile that are going to help to create that narrative because you're working for your client. That is your goal.
100%. Yeah.
Okay.
Do I care what if the other house down the street's 3 months ago sold for lower than what we want? Am I picking that one? Absolutely not. And I'm going to make a case as, hey, Mr. or Mrs. Appraiser, this is why you should use this one. We don't care about this one.
Right. And that's,
sure.
That I completely understand and have complete respect for, because you're working for your client. That's your prerogative. That's what they hired you for,
Yeah, I hope so. Yeah.
you know? And so that makes sense to me. I think like, and this is why I'm always like so baffled by the appraisal industry, is when I start to get scared is when it comes to not so much like the residential anecdotal situations of like buyer X wants to buy home Y. It's when I start to see them within mortgage investment corporations and real estate investment trusts. Like when I see a REIT and you have, and they post out, they publish like, to their investors, hey, here's a list of properties that we got
Yeah.
on file here. And they have the appraisal numbers there. And if I'm working within that market and I know what prices are for those types of properties, I've been invited to investor portfolio meetings and other events trying to get more investors into mortgage investment corporations. I was at one a few years ago at Eagle's Nest,
Okay.
which is like a really nice golf course, like
Oh, yeah.
not too far from here. And I remember sitting there and they were like pitching this mortgage investment corporation to us, to me and a few other investors. And I looked at the papers that they had handed out, and I knew some of the streets that they were had in their portfolio. And they say, here's the address, here's what the appraisal value is, here's what the mortgage rate is, here's the yield, here's whatever. And I looked at it and I raised my hand in front of everybody, and I was like, this appraisal is bogus. Like, I know this street. I work in this neighborhood.
Yeah.
I know what these houses are worth. This appraisal is it's a fugazi. Like, this is not real. You know?
It was way overvalued, the property.
Way
Yeah.
way inflated. Like,
Yeah.
hyper inflated.
Yeah.
To a point where like I had to say, if it's inflated a little bit, I can understand. Hey, maybe the house is, but like, maybe it's nice on the inside. But at that appraisal value, that whole house better be made of gold on the inside
Yeah.
for it to be worth that much. So that's where I start to get scared. How do you see the appraisal game shifting to adapt what is about to come down the chute? Which what I'm seeing is a absolute tsunami of buyer activity. How are they going to
How are
adapt?
they going? Yeah, exactly. So I think we talked about a property that was listed not far from here and sold for a lot more than what any property in
Last
the area.
week,
Yes.
with 40 offers.
42 offers on that property.
And it was not a nice house.
It was almost a teardown.
Yeah.
And the only rationale I can think of is that it was cash buyers, a company buying it, or someone that's going to develop the land, like do something with it. Because there is no, or they just have a massive amount of down payment. They don't really care what the appraisal comes in at. So there are ways around a short appraisal. Like sometimes if people have a big down payment, lenders don't really care.
And these are most likely foreign buyers who may not be foreigners. Like, they may have permanent residency, they may be a student, they may be whatever it is, but they are exempt from this foreign buyer tax. And they just need to park their money here. They're trying to get it into the country from other places.
Yeah. And then you were talking about like private, like real estate investment corporations or MICs or all that fun stuff. But we have a deal right now, and this private lender is requesting an appraisal 30 days. It has to be within 30 days of closing. So they don't want it now because the property doesn't close till July. They're getting smarter. They don't care what the property is worth today. They care what the property is worth in July. So they don't care. They don't want the appraisal done now. They'll condition for it in the commitment. And it's a smart technique for a private lender to ensure that at time of purchase, they're getting X loan to value on the property.
So they're speculating. They're saying, and probably correctly too, they're saying, hey, people aren't talking about it yet, but the market is going up.
100%. That's why they're doing it. They saw this last year. They saw this 2 years ago. And for last year, for example, if you're getting a property appraised today, you would get the appraisal no problem. However, if you're trying to get the same property appraised in July of last year, there's no way the property is going to appraise at that. So these lenders these are on the private side, they are saying, we don't want that mistake to happen again. So we don't care about what the appraisal is today. We want it within 30 days of closing.
Wow.
Kind of sucks for the client, but it's smart from the lender.
That is very interesting. So we've got a a banger of a year coming, I think, for 2023. And based on what you're telling me, and this is why I love having these chats with you, because I love to, go back and forth on, there's what I'm seeing on the transactional side of things, and then there's a lot that I'm not seeing that you see on the lending side of things. And because we're in like sister industries, right, that complement one another and need one another to actually make a deal go through, there's the intricacies between our two industries that when me and you chat, it like kind of like puts all the puzzle pieces together and actually gives us the whole picture of what's happening. So you're seeing the same thing that I'm seeing, which is we are headed for a very busy 2023, and 2024 is going to be completely bananas.
I fully agree. So clients that we've had just kind of parked over the last 4 months or 6 months, even since September.
Did they miss the boat?
They're all wanting to buy now. They all wanted to buy, and many of them are very frustrated that we are in the spot that we're in with multiple offers, and everyone can't comprehend why that is. The reason for that is everyone's jumping in at the exact same time. Did they miss the boat? Who knows? There are still deals out there.
But far fewer.
Correct. And most people would have been in a better position to purchase 2 months ago than they are in today.
And 2 months from now.
Correct. That's 100% it. Yeah. So we'll see. I think that most buyers right now are excited though, because they are seeing more properties hop onto the market. Are there a lot? Nope. But there are more than there've been in the past few months. So maybe that's like a bit of a benefit, is that they're getting more selection, more variety, even though there are bidding wars kind of coming back. There might be more, the thought process is that more properties will continue to hop on the market.
So the whole worry that was in the headlines of all these people getting forced onto the market because rates are going up, all those fears have now been quelled.
Yeah, like what I'm seeing a lot of right now is right now I'm finding a lot of people wanting to upgrade their home. So they're saying, great, it might be an opportunity to list and gain a lot of value from my current property that I have, and then I'm going to buy at a higher price point.
If somebody wants to do that, I know what I would say to them, but I want to hear your thoughts. Would you advise them to sell first or buy first in this market?
Today, I would probably advise to buy first.
Now, how do you rectify that with the risks associated with maybe not getting what they think their home is worth?
The only reason I say it's like this week, that's what I would say.
Okay.
Thought process changed. The
Okay.
reason I say that is because of the amount of people who have bought and who are buying is just like the market seems to be flooded with buyers right now. So
asterisks, subject to change next week.
Subject to change every 2 weeks. Yeah.
Okay.
So the thought process is, hey, if there are a lot of buyers out there, I don't work in real estate. I do, but I'm not a real estate agent.
Right.
But my thought is, hey, there's a lot of buyers out there. I think your house probably will sell for around what you want. Maybe not what you want, but what a realtor tells you the house would sell for.
Right.
So if you're buying at your max budget, then 100% sell first. But if you are not buying at your max, and if your house sells for 20 or 50 grand more or less than what you want, then maybe you have some flexibility and you can purchase first.
Interesting. Okay, well,
is your advice to sell first?
It depends on what type of move they're doing and how big the gap is.
Yeah.
I find that like when people are pushing the limit on what that gap is, I'll usually tell them to sell first, because I find that when people are buying, they're buying a house. When people are selling, they're selling a home. There's a lot more of a emotional attachment to it, and then all of a sudden you get sentimental value creeps in to inflate the value of the home. And when I know that they're pushing the limit on the gap there, that's when I start to get a little concerned and say, if you're really pushing it, you don't want to be stuck in a position where you've upsized, which means you're taking on a higher debt load at a higher interest rate, and your deposit is now tied up, and at risk should you not get what you needed to for your home in order to close on this property.
Yeah.
Deposits are 5%. Let's say someone's upgrading. The average price of a home, at least in this area, in York region, for a detached home is, probably $1.4 million. We're talking about
70 grand. Like, yeah.
Yeah, like that's a lot of money to risk. So if someone's really pushing the limit, then I would say sell first, and then shop aggressively. But if somebody is not pushing the limit, like, I understand if the market's going up that it may be a little bit safer to buy first, but really it's about like what is the risk tolerance for that particular client. So also asterisk depends. But yeah, I would say that this talk has given me a really more full scope of what's happening in the market in general. I really hope that everybody kind of got a lot out of this, and if you disagree or you have any comments, please hit that comment section if you're watching this on YouTube, and if you're following us on Spotify, Apple Podcasts, please follow the podcast. Thanks so much for coming in, Jeff, and we'll do this again soon.
Thanks for having me.
Thanks for listening. Don't forget to like, follow, and give us a review.